accelerated look today at some really interesting financial insights. These all come from the sources you shared with us through the fundamental platform.
Yeah.
We're focusing on, well, it looks like a collision course, really. Global monetary policy, these extreme U.S. market valuations, and some big U.S. fiscal shifts.
Yeah, and our mission, if you want to call it that, is to connect the dots. We're looking at things like tariffs, those H-1B visa fee hikes, central bank rate plans, things that seem separate. But we want to understand their, calculated effect on the dollar, global trade, and definitely the U.S. stock market, which is flying pretty high. The main theme here is this tension, right? Policy goals versus, well, economic reality.
Okay, let's start with that fiscal strategy. The first source you sent over was titled Orderly Devaluation. It seems the administration is getting pretty creative trying to tackle that massive $2.5 trillion deficit. We're seeing high tariffs predicted to bring in, what, $300 billion? And also a really dramatic increase in H-1B visa costs. The source suggests that can mean anywhere from 8.5 cents to maybe $17 billion a year.
And what's really fascinating, is how the market seems to be, well, reflecting this already. Just look at gold. It's having its second best year in 50 years. Only 1979 was better.
Wow.
And gold's price, traditionally, it's like the mirror image of the dollar's strength, right? So the source suggests this isn't just happening randomly. They actually call it the Mar-a-Lago Accord. The idea being a strategic kind of orderly devaluation to make U.S. stuff more competitive globally. And maybe just as importantly, it helps manage that huge $37 trillion national debt through, a bit more inflation.
Right. And that political agenda connects straight into monetary policy. Let's look at the next source, rate cuts plan. This one mentions a new Fed governor's speech, and according to the material, it really reflects a clear signal from the White House. They seem to want rates down around 206 basis points, so just over 2%.
Which is a huge target. I mean, a really big move from where we are. If you map that out, it implies something like 8 rate cuts between now and May 2026.
8 cuts.
Yeah. And the plan, as laid out here, would put official rates at 3.5% by the end of this year. And it seems to suggest, well, it doesn't matter what inflation is actually doing. It looks like fiscal goals are taking priority over the Fed's usual inflation mandate based on these sources.
Okay, so that's the longer-term plan maybe, but what's the market thinking right now? The next source, rate cuts in the fall, shows the market's already pricing in another cut, 25 basis points for the October 29th meeting. And the probability assigned is like 94%. That's incredibly high. And this is even with expectations for the U.S. economy to stay strong, maybe 3.5% real growth, 6.4% nominal.
But hold on, the actual data you pointed to in Running Hot shows GDP was revised up to 3.8% year over year, and core PCE is at 2.6%. That's still comfortably above the Fed's 2% target. It's hot.
Exactly.
So how can they justify 8 cuts, or even just one next month with those numbers? It really looks like an acknowledgement that the Fed is shifting towards easing, which is good for some assets, sure, but it just seems to fly in the face of the current economic picture.
And that conflict, that tension between the policy direction and the data makes the next point really interesting. The source Running Hot also mentions the Dallas Fed suggesting a shift in focus, maybe looking beyond just the Fed funds rate to include other rates, like the Tri-Party General Collateral Rate, the TGCR for managing policy.
Ah, that makes sense. It's kind of a classic response when policy and data conflict. The TGCR is a key rate for bank funding. So by shifting focus there, maybe they can sort of dilute the public focus on the main Fed funds rate. It seems like a smart, subtle way to manage things, avoid a direct clash and maybe satisfy those political pressures, even when the 2% target looks challenged by the strong economy.
And of course, the U.S. isn't making these moves in isolation. Let's look globally with the source easing frenzy. We see, 76% of world economies are actually expanding or recovering. Yet at the same time, 80% of their central banks are easing policy, cutting rates or similar moves.
Yeah, and that's the worrying part historically, right? The source points out that this kind of coordinated easing, when the economy actually looks okay on the surface, has often preceded recessions. It suggests central banks might be easing because they expect things to get worse, maybe due to worries about global trade, perhaps linked to that dollar devaluation and the tariffs we talked about.
But there is maybe a positive market effect from all this easing, at least for some. The source, Small Caps Come Back, highlights this. Small caps, the Russell 2000 index, have apparently really outperformed large caps, the Russell 1000, since the rate cuts began. They've closed the performance gap by almost 500 basis points. Seems like they're discounting this whole easing cycle. Plus, they offer a valuation argument. The Russell 2000 PE is around 17.
Compared to 33 for the Russell 1000, that 33 PE for large caps, that should definitely give investors pause. And it connects perfectly to that last source, 2.5% of the time.
It points out that equity market volatility is super low, multi-year lows, in fact, but valuations are stretched, really stretched. The Buffett Indicator, that's market cap relative to GDP, is currently sitting more than 2 standard deviations above its average.
2 standard deviations, that's rare.
Extremely rare. It's a statistical level that historically has only happened about 2.5% of the time. Okay, so let's try and sum this up. We have this global easing happening pretty much everywhere. We have U.S. rate cuts that seem driven more by political aims and debt management than inflation data. And U.S. stocks, particularly large caps, are sitting at valuation levels that are, statistically speaking, extreme outliers.
Yeah.
Levels that usually, well, correct.
Exactly. So you have this unprecedented policy path, this clear political target, maybe pushing rates towards 2%, colliding with market valuations that are in truly rare territory, that 2.5% zone. So the big question we have to ask you, the listener, is this. Are the central banks seeing some fundamental rot, some deep deterioration that the current strong data is hiding? Or is this aggressive, perhaps politically influenced policy path just setting us all up for an inevitable correction dictated by historical statistics? What's going to be the trigger that reveals the answer?